everyone. Delighted to have all of you join me for yet another webinar in the Sustainable Action Dialogue series being hosted by the Institute of Sustainability Studies. My name is Nazia Hussain. I'm the product manager at ISS. These webinars are being held to remove the jargon that is often associated with sustainability topics and hold focused discussions on content that can really allow businesses and individuals realign commitment with action. And today, I'm delighted to have all of you present for an exclusive webinar on the ESG premium and the correlation between ESG performance and company valuation. It's being delivered by Michael Costello, Group Director of ESG at Stahl, where he leads the company's strategy to drive positive industry change through sustainability. Michael works closely with customers, brands, NGOs, and universities to promote sustainable development. His expertise includes climate change mitigation, chemical management, and supply chain transparency. And I'm delighted to have him join us and look forward to his insights on the webinar topic. Before I invite Michael to deliver the session, I just want everyone to know that you've joined us on LinkedIn. So please use the comments section to drop any questions for Michael, share any thoughts, any insights you have on the subject as well. We'll have a quick Q&A towards the end, and I'll get around to asking Michael to address all of your comments. Over to you, Michael.
Thank you very much, Nazia, and welcome. Good afternoon, everybody. I hope I can help with your objective, Nazia, of eliminating the jargon and get down to some real practical stuff today. Although the title doesn't maybe seem so practical, what I'm going to talk about today is this thing called the ESG premium and the link between ESG performance of a company and the company valuation, which are quite different things. I think we all know there's a link, but today I'd like to show you what is that link, how can it be measured, and maybe how we can use it, how those of us working in these sustainability positions or even in companies can use that link. So this is what I'll talk about 45 minutes. I'll try to keep it roughly to the schedule. I may spend a bit more on the last bit, which is really the critical part. And at the beginning, I'll just make a few things clear: what ESG performance is, how do we measure it? Then we'll get some definitions on enterprise value and EBITDA, which is the way that companies often measure their performance, right? And then we'll get into the correlation between the two, and using a thing called enterprise value EBITDA multiple or ratio. That's going to be one of the KPIs we'll use today. So let's go to the first topic, which is really just to define what ESG performance is. And I think when you're measuring ESG performance in a company, the first thing you want to do really is to measure the KPIs, identify the KPIs and then measure them. Yeah, and that can be done in different ways. You can use the frameworks that are out there. To be honest, CSRD is going to determine a lot about how we measure and which KPIs we choose. But there are others, of course, and you could even decide just to focus the KPIs on climate change, in which case the SBTI might be a good place to start. But anyway, the key thing is to get those KPIs identified and use them, and then get some external input on your company's performance. Yeah, you can do that with surveys, with ratings. We'll talk about ratings. And another way to do it is to get what's called a materiality assessment, to find out what's the opinion of other stakeholders on your company's most material topics. What is important for you when it comes to ESG? This is really important. And then, of course, you can compare then with your peers and start to set targets and goals so that you can monitor the progress. So this is really about ESG performance, the way that we can measure it, because if we want to make a link between ESG performance and company valuation, then we really have to have a good way to measure it. So we also recommend to invest in measurement tools. Yeah. And what are some of those tools? Well, you've probably heard of all the ratings agencies which are out there, also indexes. And these are designed to assess ESG practices. Typically, they're for publicly traded companies. but not all. The ones you're seeing here, MSCI, the FTSE Index, Bloomberg, Sustainalytics, these are often designed to give ESG ratings for publicly traded companies. I work in a company that's not publicly traded, and we use EcoVadis. So there's different ratings agencies there, but basically they tell you how you're doing, really. What is your ESG performance, and how do you compare with your peers in the industry? Also, the indices do the same thing. If you don't have the option to do that, then it's a really good idea to get a third party to conduct annual audits on your company, ESG audits. And that way you can really nail down what you should be measuring. We use, for example, Deloitte, Ernst & Young. There's a lot of companies out there that can do this. And they help you to nail down what's really important in your industry to report and to use as KPIs and performance. And it's always good to get surveys, do a materiality assessment, get other companies to view how they think you're doing, what they think is the important material topics for you. And then you can also look at different platforms for tracking ESG metrics. There are a lot of these out there. Be careful, because some of them are not real, but there are a lot of good ones. And again, it's all about measuring, because if you can't measure, then you can't improve. That's a scientific, a very basic scientific thinking, right? You have to be able to measure something to be able to improve it. So those are some of the tools you can use. And in our case, for our study and research today, we've taken ESG ratings. We've taken a study that Deloitte did as an example, where they grouped ESG ratings for different companies. And these are the typical ESG rating systems that they used. So that's quite a common way to do it. Yeah. Okay, so that's ESG performance and ratings. What about market value and company valuation? Well, let's start with just a couple of definitions: the enterprise value and the EBITDA. I'm sure you're familiar with these. You've heard of them. But just to recap. A company's enterprise value is basically its equity value or market capitalization plus its financial commitments. Yeah, so it's a number in dollars or in currency. Yeah, it's to express that. And then the EBITDA, which you hear a lot and is used a lot, although not everybody agrees with using it, by the way, but it is used a lot. These are the earnings before interest, taxation, depreciation, amortization. So EBITDA is often used in valuation because it's a measure of profitability. It's a measure of cash flow. It can tell a little bit about a company. Some people use it more, others less. But what's really common now in valuations is the EV/EBITDA multiple. Yeah. So what that means, it's a ratio basically of the two, EV and EBITDA. But what it's used for is as a valuation metric to compare the value of different businesses, but especially to acquire companies. So if somebody wants to acquire a company, they will often use this multiple or ratio. It's usually a number like 5 or 10 to acquire that company. They will say, okay, your company is in this industry, and typically that industry has an EBITDA multiple of 10. So I'm going to buy your company for 10 times your EBITDA. So if your EBITDA was 250 million, then they would pay 10 times 250 million for that company. Yeah. So it's used for helping acquiring companies to understand the value of that business. Yeah. This is important because it's the measure that's used in the research that I'm going to present and the study that Deloitte did. Yeah. And here's an example. I'm not in the beverage business, but if I was in the beverage business or wanted to get into the beverage business and was looking to acquire a company in that industry, you might go and say, okay, the third one down, Dr. Pepper Snapple. Historically, that's had an EV/EBITDA multiple of 9.7. I'd like to buy your company for 10 times your EBITDA, and that would be like a starting point. So maybe this is not new for you, but I just wanted to get those definitions clear before we get into the real content here of this presentation today. So the question then is, does a company's ESG performance, if it's measured this way by ratings or by scores, does that have an impact on its market value? The market value measured by EV/EBITDA ratios, for example, or multiples. So I think we all have a sense that this is the case, but exactly how does it work, and by how much, and what does it mean? What does it mean for us working in companies? How can we use it? Yeah. So that's what I'd like to discuss now. The correlation, and this is the bulk of my discussion today. Hopefully you'll have lots of questions about this also, because the correlation is quite clear in some cases, but there are mixed results in others. And what Deloitte did is they studied over 300 publicly traded companies, and they grouped them into different industries. So they chose companies from different industries and tried to make a correlation between their ESG scores and their EV/EBITDA multiples, their market valuation. So without being too simplistic, they got some data from those companies, and the first thing they did was to weight the individual KPIs in terms of their ESG performance under the three pillars of ESG: the environment pillar, social, and governance. So they put a weight on these KPIs, and this is typical of the way many companies score this. But this is the way Deloitte did the study, and they used scores from Refinitiv, which is, like Sustainalytics, one of those kind of companies. And you can see here that the weighting is split pretty evenly, but you've got more weight in things like emissions and resources, human rights and workforce, and then management, how you manage the company. Those are the key topics here. So they got scores from these 300 plus companies, and they got enterprise value and EBITDA data from them. And they looked to see, was there a correlation? Yeah. So here are the scores. And the way Deloitte did the scores is they had a 0 to 100 score, which was taken from all the scores that these companies were using on the market. It could be Sustainalytics, it could be anything. And they kind of grouped them all together, averaged them, and gave a score based on that. So 0 to 25 is the dark blue score, grade D. So if a company has a score of 20, then they fall into the dark blue category. From 25 to 50 is the light blue, grade C. 50 to 75, grade B, the dark green, and then grade A above 75. So these companies ran the gamut. They were split between these different scores. And if you look at the totals on the right of the screen, you can see the average of all the companies, but also nice to see that there's not too much variation between different industries in this case. Yeah. So that's how it was split up. And then if you keep that picture in mind, they did the same thing then for those same companies, looking at their EV/EBITDA multiple. So this is the EV/EBITDA multiple, and that number you see in the bars is the multiple. So it ranges from a low of 5.95 to a high of 20.16. 20 is a very high multiple, by the way. Who knows what company that is? Could be a very specialized company, but a very high multiple, very high valued company. 5.95 is not so bad. It depends on the industry you're in. It could be a basic commodity chemical company, energy company, for example. It's quite typical. But I think the point here to show is that there seems to be a very direct, and I'm going to flip back again, correlation between EV/EBITDA ratio and ESG performance as it was scored. However, and this is really important, the EV/EBITDA performance can have many other factors linked to it, not just ESG performance. So that's really important in this study. And what Deloitte then did was to isolate the ESG performance part of the study to link that better with EV/EBITDA. And what they found was that if and they did a regression analysis to do this, all sorts of fancy statistics. And what they did was they were able to isolate it, and they found two things. The first thing is that, yes, the higher the ESG score at any point in time, then the higher is the EV/EBITDA ratio, as much as 1.2 times the EBITDA. Yeah. So instead of 10, it would be 12 if you had the higher ESG score. Yeah. But I think most interestingly, they also found with the same regression analysis that the higher is the change in ESG score, then also the higher is the impact on EV/EBITDA ratio. So if you change your ESG score, for example, you go up by 10 points from 70 to 80 or from 40 to 50, then the impact on your EV/EBITDA ratio is more. It's 1.8 times, which is really quite significant when you're thinking about the kind of money that people pay for companies to acquire them. That's a huge impact. Now, this is just one study, and I'm not going to hold my hat on this one necessarily, but it's a very nice, clear way to illustrate what we're saying, and what they found was the very positive correlation between the two things we're looking at. But me working for a company, I said, okay, let's see if I could apply this to a real company that makes something. And this is a fictitious company I'm going to show you. It's not mine. But I wanted to apply it to something real to see what it actually means for a private, non-public company like the one I work for. So what I did was I made a couple of scenarios. Yeah. Let's call them ESG premium scenarios. So the ESG premium is the positive correlation between ESG performance and valuation. What I thought was, what if a company wanted to be acquired, if it was putting itself for sale over the next 10 years, yeah, and it was looking for buyers. And two scenarios, yeah. In the first scenario, the company decides not to invest in ESG performance and not do very much, just focus on the bottom line, focus on selling and making money and getting the most out of the company, but without real progress on ESG performance. And the second scenario would be if that same company decided to invest on ESG and make significant progress over these 10 years versus its peers. So we're going to look at those two scenarios and see what actually happens at the end and what is the real value and what does it mean. Yeah. So if we move our eyes to the left, we see that the first scenario, where there's limited progress on ESG performance versus the peers, what I'm assuming here is that this particular industry grows at about 2% compound annual growth rates over the period. So the sales will grow at that rate and arrive at 2030 at about 1 billion. However, because of the limited replacement of fossil fuels in this particular company's portfolio, they've also spent very little on climate. They haven't hired people to work in sustainability, for example. And as a result of that, they've been using EcoVadis, and their score from EcoVadis drops from a gold rating to a silver rating. So that would be the equivalent of, say, a drop in 10 points in the previous analysis from Deloitte. Yeah? So that's the scenario of the company in the case where they do not invest in ESG performance. So what happens if they do? Well, what I have said here, and this is not necessarily the case, but I just wanted to make the point that one thing that can happen when you invest in ESG is that you could, in the short term, lose some sales because you're replacing some of your portfolios with renewable products, which may be more scarce and more expensive, and you might lose some business. You also have to spend a bit. You have to hire some staff. Maybe you have to install some solar panels, which take 5, 6, or 7 years to return their investment. So there's some investment here that's required to be a better company, to be a more performing ESG company. So what I'm suggesting here is that the sales revenue does not grow. It does grow by 2%, but then you lose these sales, so you're only at 900 million after 10 years compared to 1 billion for the other company. However, because of what you've done, your score, your EcoVadis score in this case, or ESG score, goes up. It goes up from gold to platinum. Yeah. So that's the scenario 2. Let's see what that means. So let's go back to the left-hand side. And again, these are fictitious data, but I think they're also quite realistic for this size company. Back to scenario 1, where there was limited investment in ESG, the EBITDA of that company is typically 25% of sales. So we're going to say that that stays the same at 250 million, 25% of 1 billion. And their EV EBITDA multiple actually drops by 1 because of the drop in EcoVadis score. So they were demoted, let's say, in EcoVadis because of their lack of investment on ESG, and the multiple went down to 6. Yeah. So that's my dog there, sorry. In the case on the right, the EBITDA actually dropped to 200 million in that case, which was 22% of sales. And at the same time, the EV EBITDA multiple actually rose from 7 to 8. Why? Because the EcoVadis score went from gold to platinum in this case. So I guess the point I'm making here is that sales have gone down, and even the EBITDA has actually dropped. But the EV EBITDA multiple has gone up because of the ESG performance. So what does that mean? If we go back to the left, what that means for the first scenario is that if a company was coming to buy that business, they would have to pay 6 times, 6 is the multiple, 6 times the EV EBITDA, 6 times the EBITDA. So they would pay 1.5 billion for the business. And on the right, in the case of ESG higher performance, they actually would have to pay more, 1.6 billion, because they're multiplying the EBITDA by 8 in this case. Okay, so this is a theoretical acquisition price, but what I'm saying is that in this quite extreme case, you could even potentially lose sales, lose some profitability, but get more for your company because of achieving ESG performance. And that is the ESG premium, the correlation that we mentioned before, put into real numbers. So that means for people, for example, like us working in multinational companies, that maybe we want to push an initiative to the management of the company, we could show them something like this based on real academic studies, that yes, we may have to suffer a little bit in the short term, but in the long term, our value as a company is going to be enhanced by investing in these ESG initiatives, even if sales and potentially even profitability go down in the short term. Of course, you would expect profitability to increase then in the longer term, and I believe that would be the case. But I just wanted to demonstrate it in this quite extreme case that you can still, increase the value of your company even if you're selling less. So the conclusions then we can take from that are several, but in general, there's a positive correlation between ESG performance as measured by these ratings, yeah, and company valuation, yeah, and the company valuation as it's measured by EV or EBITDA multiples. However, the research findings are mixed, so I'm not going to say that we shouldn't hang our hat on one report, on one research study done. But the evidence so far is that it's a generally positive one, but we do see some reports giving positive correlation for individual ESG topics, but they may also have a negative correlation on some selected ESG topics. For example, I've seen one on environment where they didn't get the return on that investment as quickly as they thought, possibly because it takes more time to develop, whereas social ESG topics like DEI or safety or something more concrete, you can change more quickly, whereas emissions and environmental compliance can take time, as you know. And then thirdly, the payoff for ESG performance investment may not be an increase in the short or medium term revenue. We saw that. It may even drop in revenue, but even if it's a flat or very short, very small growth, you may not see that in the short term. However, company valuation should rise as ESG performance rises, and that is really the point I'm trying to make here, that even though you may get a hit in the short term, the studies and the academic studies seem to show that the correlation is overall positive, even if some of the research findings are mixed. And it's also my experience, by the way, in the company that I work for, that we have seen this ESG premium, maybe not so tangibly yet, but we certainly see it in the reputation that we get, and the reputation of companies who do this are definitely enhanced, and that helps your overall performance, of course. So I think we'll have time for questions, but that's basically what I wanted to discuss today. There is good bibliography on this, good information available on all of this stuff, and I've listed it here, but there's much more. But I'm really happy to take questions now from anybody. Yeah.
Thanks, Michael. That was a very interesting session. It was good to see that there's, of course, that positive correlation between ESG performance and the value of a company, even if you're selling less in the short term, right? I would, of course, request all participants to share any questions that you have in the comment section. But just to kickstart the Q&A, would you be able to just explain a bit more about that significance of EV, EBITDA multiples, and how ESG performance impacts these multiples?
Yeah, sure. It's a market perception, really, because what the marketplace is saying, and I'm going to go back to the study here. What the marketplace is saying, this is the evidence of the Deloitte study, is that they're valuing ESG scoring in terms of what the company is doing at the point of acquiring a company. So they will pay more for a company, and it's probably to do with risk, right?
Yeah.
They'll pay more for a company if they believe that they're managing ESG properly, that their governance is good, that the environmental performance is good, that they're taking care of their people and the workers in the supply chain. So given the importance of those three elements of ESG in society, that they feel more comfortable, and they're willing to pay more for companies with that profile. So that's the concept here of why the valuation is higher. Yeah.
Yeah. What role would you say that external ESG audits can play in influencing the market perception and the overall enterprise value of a company then?
Yeah, the auditing is important. The way it works for publicly traded companies is that these ratings companies like MSCI, they will look at your public data, and they will look at your ESG report and your financial reports, and they will do the analysis from your reports. Yeah, they won't come and do an audit. Yeah, so they'll take the information that's made public, and they'll give you a rating based on that. Yeah, or if there's been any publications about your company, or any reports or complaints or whatever. In the case of a private company like the one I work for, you need to get a rating system that applies to you that's usually not those. EcoVadis is one of them that we use. But then the best way also is to get one of these external companies to come and visit and audit your company. We do it every year. We have 3 audits at different sites every year. And then they audit your corporate ESG performance or goals. And they dig into the KPIs that you're measuring. They make sure that you're measuring them properly. Now they won't give you a rating, but what they do is they recommend certain things for you to do in the meantime for next year, so that you're still always improving and you pass the audit. Of course, you have to pass the audit in order to continue with them. And that is really helpful for a private company like us, because we don't publish all of our data necessarily like a publicly traded company would have to.
Yeah. I think that also brings us to the question of just ESG frameworks, right? There's a question here saying how there's a lack of standardization in ESG rating methodologies, and then what steps can be taken to improve transparency and comparability of ESG ratings, which clearly impact the company valuation.
Yeah. I think the steps are just to be transparent, to convince the leadership and the management of the company to publish data, and not to be necessarily scared of opening up the books a little bit, because that's the way this is going with CSRD, which is coming, Corporate Sustainability Reporting Directive. I think you'll probably have another webinar series on that one. But with that coming, we all have to be more transparent anyway. And the idea, of course, then is that we cannot greenwash. That one of the reasons for CSRD is to prevent greenwashing, to stop companies telling everybody that they are the most sustainable when really the data isn't supporting that. So it's coming anyway. So it's in our interest as companies to start reporting more transparently now, even though in the future it's going to be forced upon us. Yeah.
Absolutely. And do you think that ESG ratings can positively influence bank ratings, potentially leading to more favorable interest rates for the company?
Yes, because you can, if you refinance your company, for example, if you ask your banks for a refinancing credit facility, then there are credit facilities available now which are called, green or sustainable credit facilities, in which you can get a discount on your loan for higher ESG performance, as measured by certain KPIs, which would be defined in that loan credit facility. So those are available. We have some experience with those. And for example, you could have maybe your DEI KPI, your emissions target for SBTI, and then maybe something related to compliance or something like that. So you could have a list of KPIs linked to your credit facility loan. And if you perform on those, then you get the discount of maybe 1/4 of a percentage point on your loan. If you don't perform, then maybe you don't get that discount, or maybe there's even a penalty. It depends on the type of credit that you get. But that's absolutely part of this story, and related to, of course, your valuation and your score. Yeah.
Right. And so management bonuses are often still linked to short-term targets, and there's a participant asking, how do you encourage top management to increase ESG score over maximizing EBITDA performance?
You mean for individual compensation for management? Is that what you mean?
I guess so, yes.
Yeah. Well, yeah, that's a really good one. I mean, most companies now, if they're looking into ESG and working on ESG, they have some element of their compensation plan linked to ESG. But it's not always linked necessarily to the score exactly, because that is quite specific. Yeah. But in the future, as the scores develop and become more standardized, then you could have that link made to compensation. Now, from my understanding, the compensation or bonus plans are more linked to a general performance in ESG, like the reputation you have, or maybe they're looking at specific KPIs that you've defined, rather than linking it to the score that you get, because the different scores that they have in the marketplace can emphasize different elements of ESG, and that might not be relevant for all the different kinds of companies in different segments, for example. Yeah.
Yeah. I think I'll wrap up with this question. It's just around challenges.
Yes.
What are these common challenges that companies are currently facing when it comes to improving ESG performance? Because, like you said, with regulations such as the CSRD coming down the lane, I know companies are in panic mode, right? There's that sort of fear, but at the same time, you need to, address the challenges that you're facing. So, what are some of those common challenges, and what would you propose are not quick but rational solutions to solving them, not being fearful of these regulations coming your way, but ensuring that you're using that standard for your improved ESG score?
Yeah. Well, of course, embrace them. I mean, we're all under tremendous pressure to manage these challenges. Embrace them, but also embrace them by investing in people
Yeah.
working on it, whether it's CSRD, whether it's environmental challenges. You need people to focus and manage these issues. And with the evidence that I've just shown in the presentation, that is a way to sell this to the leadership or management of a company, that it's not just a cost, that they shouldn't consider this as a cost and a kind of something that we have to do, and it's not a compliance thing. It's
Yeah.
something that can actually increase the value of the company more than many other things that you're doing.
Yeah.
So if you bring it to your management in that way, then the challenge can be overcome. That doesn't mean to say it's easy. And there are challenges. For example, one of the biggest challenges we face as a manufacturing company when we make chemicals is, greenhouse gases. We've made a commitment to the Science Based Targets Initiative that's aligned to the Paris Climate Agreement goals. But that's very ambitious. It's very ambitious. And we depend on our supply chain in the chemical industry to help us to achieve those goals, but we don't control all of the supply chain. So that's one of the challenges that we have, and all companies have. It's not just us, but it's quite specific example, that there are many things out of our immediate control, yet we're depending on them in order to achieve our targets. Yeah.
Yeah, I think bringing back the whole conversation around scope 3 emissions, right, and relying
Exactly.
on your
That's exactly.
supply chain
Yeah.
stakeholders, to even get the data right. And I think there's just this fear of ensuring that when you're trying to understand data, you're getting it right too, right? And a lot of people will probably leave it onto the company to give you that data to interpret rather than doing it yourself, right?
Right.
So it's that challenge as well. But I think if there aren't any more questions from participants, we can wrap it up. But any final thoughts from your end, Michael?
No, just again to make the point that there is a link between ESG performance and company valuation, and I would encourage people like myself working in companies who are trying to push through initiatives to use these academic studies to sell that idea, to show that this isn't just about being good. It's partly about being good by doing better, but it's also about enhancing the value of the company. And this really contributes to that, in spite of the headwinds that we see all the time. It seems to be a pretty clear positive correlation that you don't always get in other parts of your business. So let's use it and use that to make ourselves better. I would say, yeah.
Absolutely. Brilliant. Thank you so much, Michael, for that. And I, of course, encourage all the participants to take the insights and the strategies that you've learned today and apply them in your organization. And of course, let's continue this conversation, share our successes and challenges, and just collectively work towards a more sustainable future. Thank you so much for your participation. Please keep a lookout on ISS website as well as our LinkedIn channel for all our future webinars and sessions. We'll be happy to welcome all of you back again for yet another webinar with another expert on another important sustainability topic. Thank you so much, everyone, for joining, and a huge thanks to Michael for today's session. Thank you so much, everyone.
Pleasure. Thank you. Bye-bye.
Thanks, Michael. Bye-bye.
Bye.